Welcome everyone to Climbing Out of the COVID Crisis, Structuring M&A Deals During the Pandemic, Lessons Learned. Our speakers today are going to be Conrad Everhart, my partner at Flatiron Law Group, and then Kate Mann from Bowen Tax Law, and Mark Gato from Falcon Capital. The session today, I've opened it up to make all of you that are interested to be participants as well, since the team is small. I just again request that each of you, hang on, we got one more person who's joining us. I ask that each of you keep your mics muted. If you have a question, you are welcome to ask your question. Either find a silent moment to interject, and if not, if you can't find a moment, just ask your question in the Q&A box on Zoom, and then when I see it, I'll poke either Conrad or Kate or Mark to raise the question, and then it can be interactive. Again, this is a small group, so we figured it'd be better to open it up to everybody. A couple of rules of the road. We are recording this session. We have a venue on YouTube, although we don't have 100 subscribers yet, so it's not branded yet. But if you search for Flatiron Law Webinars and look for the webinar series, we have a Flatiron website regular, but this is on YouTube, Flatiron Law Webinars. Each of the videos will be posted there. This video today will be sliced into pieces so that you can digest the various issues that Conrad, Kate, and Mark will be talking about into 4 different segments. I'm going to pass it over to Conrad, and then at the end of the day, end of our session, we'll do a close to remind you of a couple things as well. So with that, I'll let Conrad take over. Go ahead, Conrad.
Hey guys, folks, this is Conrad Everhart. I'm one of the founding partners of Flatiron Law Group. This is a Falcon Flatiron production. It's a 6-part series. This is webinar number 2. We're going to focus today a little bit about how we're seeing deals getting done and how sellers are tinkering with the traditional dynamics. I'm joined by Kate Mann of Bowen Tax Law in Los Angeles, and by Mark Gato of Falcon Capital. Kate, why don't you introduce yourself quickly?
Sure. Hi, so I'm Kate. I'm from Bowen Tax Law. We're a transactional tax firm. We handle kind of all aspects of transactional tax. Our focus is on mergers and acquisitions and acquisitive transactions. We work very happy to see you all today.
Mark?
Hey, good morning, everybody. My name is Mark Gato. I'm a managing director at Falcon Capital. We are a investment bank located just outside of Philadelphia that focuses on M&A advisory. The overarching focus is technology, software-enabled services, other services around tech. We have a healthcare practice run by my partner, Ted Stack, and I run the enterprise software stack. And we also have a team that does, those 2 practices are national, even international in terms of our clientele and buyer base. We also have kind of a regional industrial practice too. There's 12 people in the firm. We've been around for 20 years. And we transact somewhere in the neighborhood of about a dozen transactions a year.
All right, thanks, Mark. And Flatiron Law Group is a next-gen M&A boutique. We do deals, nothing but deals. We do M&A, private equity, venture capital, a little bit of technology licensing, and a little bit of startup work. We are an innovative place. We flip the traditional law firm model, and we price ourselves principally on a fixed fee basis. We do that through various methodologies, including by using our own digital deal platform called Deal Driver that Lenny's the architect of. We also deploy other innovative strategies to do that. And I'm Conrad Everhart, one of the founding partners. So why don't we get started, Mark? You guys ready?
Ready to roll.
Lenny, everybody can see the screen?
Yes, they can.
All right. So guys, we talked about last time that, after the nuclear spring, once COVID hit back in March and April, deals are starting to get done again. and buoyed in part by the strong stock market, and in part by the fact that there are certain areas that are actually doing well in this era. Companies that produce and provide services and products that help others do business virtually, like e-tech, e-health, e-reg, all those sectors are booming right now. So deals are getting done. We've here at Flatiron, we've closed 6 deals during the pandemic, and we have another at least a half a dozen in the pipeline. And you heard that the folks at Falcon have closed more than that. So we're in a position, we've accumulated enough data over the past few months that we can start drawing conclusions. We can start discerning patterns from the deal work we've been doing. So while deals are getting done, what we're seeing is that sellers are pushing more of the risk buyers are pushing more of the risk back onto sellers in order to get the deals done. In part, the way they structure the deals, in part by pushing the purchase price into earnouts, tying the purchase price to future performance, in part by screwing around with the balance sheet and working capital adjustment. And of course, because of the stock market, you got buyers that are using their stock as currency. We're probably not going to we don't have enough time to get to the stock component of all this. We can do that in a separate webinar. That's a whole different ball of wax, but we'll cover the first 3 items in the time we got allotted. So let's talk about structuring deals first. Historically, tech deals have been done as stock deals, which a stock deal is a deal where the buyer acquires the target by acquiring the equity ownership, the shares of the company, either by a merger, a reverse triangular merger, or by way of just a direct purchase of the stock. In a stock transaction, the corporate existence of the target isn't disturbed. Only the ownership changes. The company continues for all intents and purposes. The inbound licenses aren't disturbed. The customer licenses aren't disturbed. The employment relationships aren't disturbed. The company continues. It just changes ownership. Typically, in a stock transaction, that will trigger capital gains for the sellers, provided they've held the stock for the requisite holding period. And sometimes the taxable event can be deferred depending on how much of the purchase price consists of equity rather than cash. So that's sort of what's happened historically. Frankly, I got to admit, I haven't done an asset deal in tech in almost 20 to 15 years before this year, when we've done several. So one of the things we've noticed over the past few months during the pandemic is that buyers are asking to do deals as asset sales. So when an asset sale, you're acquiring the assets or some assets, the IP, some people, the inbound licenses, the technology. You're acquiring assets and you're assuming some liabilities. You're cherry picking those liabilities you're willing to assume. And in an asset sale, your company, if you're the seller, the target continues to survive but stays behind. It doesn't change ownership. It continues to survive as an independent entity, being left behind. And then you ask me, why do buyers want to do that? Well, there's a good reason buyers always want to do asset sales, is because they get the step up in basis of the assets. They can allocate the purchase price across the assets, and that generally results in a bigger tax write-off for the buyer. Tax is not always the motivator, like we had in the Avalara deal. Sometimes a buyer has enough loss that having more losses isn't really all that interesting. What do you see, Kate?
Yeah, I'd say, tax is a motivator, but I'd say probably the bigger motivator is corporate concerns here, leaving liabilities behind, not having to deal with historic issues that, exist within the business. That's usually what we see being the biggest reason why people are going towards asset purchases. Yeah. But definitely whenever, buyer wants to get the most bang for its money. And so if it can buy whatever the business is plus acquire an asset, a tax asset, it's going to want to do that. So that's where, as Conrad was mentioning, the ability to depreciate or amortize the assets going forward to offset taxable income is very attractive to a buyer.
Now, the good news, guys, is, asset sales aren't always bad for the seller because they bring theoretically more tax value to buyer can sometimes pay more. So, when you're structured, that's why you're hearing a lot of talk in the startup community now. If your exit is likely to be a sale rather than an IPO, you're better off in an LLC format because it lends itself to an asset sale, which will attract a higher purchase price. So so number two, as Kate points out, that buyers are looking to leave liabilities behind. And in this COVID period, where there's so much uncertainty, they can leave the COVID baggage behind. They can leave if they do an asset sale, they can leave the PPP loans behind. They can leave all the risk that's attendant to the business pre-closing, potential infringement, privacy, technology, employment. All those liabilities can be left behind. So it becomes a less risky proposition. Of course, it also eases the transition burden in the HR. When you think of a stock deal, the buyer has to inherit the entire plate of benefits and employee stuff. The employees are out on COBRA, the benefit plans, the stock option plans, all that stuff, all that baggage has to move. In an asset sale, all that baggage stays behind. The buyer can pick and choose which employees he wants, and he can leave the other ones behind for the seller to manage. And the related issue, Mark, is that an asset sale in this environment is easier to justify for the buyer to give you a higher price, and it's easier for him to sell to his corporate constituencies because he can go back to his board, he can go back to his investors, his private equity fund, and say, yeah, we're paying a lot, and yes, COVID is a risky period to be doing an acquisition, but the liability profile is smaller.
So, hey, I have a question for Kate, Conrad.
Yes.
So sometimes in an asset deal, the tax impact, isn't impactful as isn't as bad as one would think, or compares favorably or equally to a stock deal. You have any comments on that?
We're going to have a whole slide on that, Mark.
Sure. Yeah. We could jump ahead or we can hold off, whatever you want to do, Conrad.
No, let's we'll hold off.
Okay.
Okay.
Sorry, so let's go to the next page. Why do sellers care about whether going sort of let's go start answering your question, Mark. Why do sellers care? Why do the sellers care if it's an asset sale or if a stock sale? First of all, because it can have a dramatic impact on your tax position, and we're going to dive into that a little bit more. Secondly, because your liability profile, frankly, is a lot worse in an asset sale than it is in a stock sale. Because remember, when you do a stock deal, what happens is, the ownership of the company changes, but the company continues its corporate existence and it continues to operate the business. The founders or the sellers give a set of representations and warranties to the buyer about the state of the business. And typically there's a negotiated liability protocol, an indemnification protocol, where there's a basket, there's a cap on the amount of liability, and typically there's an escrow holdback in the 10 to 20% range. And that 10 to 20% range it will cover all the liability that's attendant to the company after the closing. Remember, in an asset sale, you still are going to go through that exercise of rep and warranties, but it's only going to apply to the business after the closing. Everything that preceded the closing is still on your plate. That doesn't pass to the buyer. It stays in your original company, and that company is still liable for that. The third reason why a seller cares is the logistical burden. The reason why tech companies, the tech transactions have been traditionally structured as stock deals, in part is because there's so many moving parts in a tech company. There's IP, there's registered IP, there's unregistered IP, there's inbound licenses, outbound licenses. There's customer contracts. Some of those customer contracts have anti-assignment clauses. So the logistical burden, we just did, as you know, we did the Avalara business licenses deal last month. Business licenses at 250 customer contracts. We had to bring in software to crunch the contracts to see, which one of those contracts triggered assignment consent rights to the customer. In a stock deal, typically there's no analysis at all. Now, there are change of control provisions in some customer licenses, but those are fairly rare. Obviously, the HR burden is a lot greater in an asset sale because you're stuck with winding down your own benefit plans. Technically, in an asset sale, for an instant in time, even the employees that are going to get hired by the buyer are going to be terminated. And that termination may trigger all kinds of rights under employment agreements, severance policies. If you have more than 100 employees, it can trigger Warrant Act issues. So there's a whole set of HR burdens that are associated with an asset sale. And finally, you get other surprises. We found out, quite to our chagrin, that selling a software company in New York triggers a transfer tax. There's no exception. There's no bulk sale exception. So if you're selling software, which is essentially inventory, that doesn't trigger a tax. But if you're selling software that you use to run your machine, that can actually trigger a transfer tax, which would obviously not happen in a stock sale. All that means is that that asset deals are actually more legally expensive. So now let's go to your question, Mark. If you're a seller, can you do an asset sale? So let's break it down. If seller is an LLC, you're a partnership, you're a pass-through. Generally speaking, an asset sale is manageable. The key and whether you structure it as a stock deal or an asset deal, Kate, should in most cases shouldn't have a meaningful difference.
Right. That's right.
So what happens
for the buyer's perspective, the asset.
Yeah.
Yeah. So from the buyer's perspective, assuming a sale of 100% of the assets or of the company, this is just the same for tax purposes for the buyer. So from a tax perspective, the buyer doesn't care about the structure here. And same goes, absent special circumstances, the seller is usually ambivalent as well. When you sell a partnership, an LLC treated as a partnership, the seller can generally expect capital gain treatment on the gain, except to the extent any of the purchase price is allocated to what we call hot assets. These are assets that produce ordinary income, things like inventory, unrealized receivables. And that's the case regardless of whether we sell the stock, the equity interest in the LLC, or whether the LLC is selling its assets. In both cases, we have to do a purchase price allocation that will determine the character of the gain to the seller. So in the case of an LLC or other partnership, it's not usually from a tax perspective a big deal whether or not we're doing an equity sale or an asset sale.
If we have an S corp, that's a pass-through entity but it's set up as a corporation. Tax planning can be a little bit more challenging, but usually you can get there in terms of an asset sale.
Yeah, so an S corp is sort of a hybrid of a C corp and a partnership for tax purposes. It's a flow through for income tax purposes. But also in some states, it is subject, unlike an LLC or other partnership, it is subject to an entity level tax. So here in California, S corporations are subject to a 1.5% entity level tax. When you compare the sale of the stock of the S corp, it's fairly simple. You're selling stock in an S corp. The seller can expect capital gain. We don't need to do any type of an allocation amongst the assets. You're done. When you sell the assets out of the S corp, there's more tax leakage and there's a couple of considerations. There's the transfer tax issue, which Conrad mentioned. In addition, you now have an additional entity level tax, depending on where you're operating, where you're subject to tax. So if your business is in California and your S corp is selling its assets, that sale will be subject to that 1.5% tax. Then we need to allocate the purchase price among the assets of the S corporation. Some of those assets will result in capital gain. Some of those assets will result in ordinary income. Since an S corp is a flow-through, the S corp will sell its assets. It will recognize capital and ordinary gain, and that will flow up to the seller, and that's how the seller will recognize gain on the transaction. So there is some tax leakage there to the seller, because rather than just simply having capital gain and no entity level tax on the sale, now the seller could be subject to some ordinary income, and there's some leakage resulting from the entity level tax, assuming that is relevant for your transaction. Usually, I'd say in the vast majority of deals, the tax benefit to the buyer of structuring the transaction as an asset purchase out of an S corp for tax purposes outweighs the tax leakage to the seller. So usually where we end up is an increase in the purchase price to make the seller whole. The buyer will increase the purchase price so that at the end of the day, once you take into account the tax leakage to the seller, they end up in the same after-tax position they would have ended up in had they simply sold the stock of the S corporation.
All right, so then I'll quickly throw out there, Kate, the 338H10. If you're an S corp and your buyer is principally motivated by tax, by the tax impact and not liability or corporate considerations, you can, under 338H10, a buyer can get the benefit of the tax outcome and still structure the transaction as a corporate transaction. We're not going to dive into the details of that.
That's right.
Understand there is that option. The final situation is if you're a C corp, and historically most venture-backed companies have been C corps, although you know that philosophy is being re-examined. If you're a C corp, if you're involved in an asset sale, it's going to trigger an entity level tax and a stockholder level tax, unless it's a fire sale, the basis in the assets is very high, or you're a unicorn and you're sitting on a lot of losses. Kate, I mean, in most cases, a C corp, difficult to structure an asset sale, right?
Yeah, I'd say difficult to / impossible. Usually, you know, when I see a term sheet with a C corp seller and it's structured as an asset purchase, you know, my first call is to the company to say, you know, do you have exceptionally high basis in your assets, or you're not having a lot of gain? Do you have losses? And not only do you have losses, but are those losses, are you very comfortable that those losses are not limited? Because even if you have a bunch of losses on the books, it's possible that all or some of those losses will not be usable to offset the gain. So unless you have special circumstances here, it's usually just, it's not possible to do an asset sale out of a C corp.
Hey, Kate, Conrad, what about, is there anything sellers could do pre-exit to kind of insulate themselves from an asset deal?
Well, that's the next page here, right? Here we go.
Do you see a lot of people doing valuations?
Yeah, well, that's what I was going to say. Look, in the next page here, if you're an LLC in particular, or an S corp, Mark, scope out, consult with you and the banker, consult with your CPA and audit firm, and scope out the tax consequences of the asset sale. I mean, Lenny can build a spreadsheet for you that's illustrative across multiple exit scenarios. So you can see, you know, what your transaction looks like at different exit evaluations, as a asset sale or a C corp. I mean, as an asset sale or a stock deal, and you can do that allocation exercise internally that Kate was talking about, allocating the purchase price between the capital assets and the ordinary income assets.
Yeah, precisely. I mean, you know, one of the things that amazes me is that owners, you know, boards don't go through this kind of pre-exit planning, scenario analysis with, you know, a bank, a valuation expert, or, you know, your attorneys, and even your wealth managers, your estate attorneys. I mean, so it just makes good, it's common sense to kind of prep so that we, as your advisors, all of us on this call here, can better think, can offer strategies, can get our positioning down and our, negotiating positioning down so that we can get the deal that that you need, really.
Sure, Mark. I mean, if you're an S corp, you figure out ahead of time what the differential in value is to you on an asset sale or a stock deal. So you have that information available to you when you go to the negotiating table. Sure, I'll do an asset deal, but I'm going to be $5 million under because of that. You got to gross me up. It's
Right.
Have that data. You always want to have data.
Yeah, it's the make whole comment Kate made, a couple slides ago. You need to make us whole.
So let's quickly go through things we can do to mitigate the tax risk. We just talked about, scoping out the tax consequences ahead, allocation of the purchase price. When you're negotiating your asset purchase agreement, bargain for a seat at the table. It's great if you can agree on the allocation of the assets beforehand, but that never happens because the buyer doesn't have enough time or information to do that. But at least bargain so that you have a right of consent and participation in how the assets are allocated. Remember what Kate mentioned, there's an allocation between hot assets and ordinary income assets, and you want to the extent possible everything to be allocated to your capital assets to generate a capital gains outcome. And the same with the third point, you can agree in the purchase price, you can agree in the asset purchase agreement on general thematics. You may not be able to agree on the exact allocations, but you can agree on thematics that you're, to the extent possible, you're going to allocate things in a way that's going to be tax advantageous to the seller. And Kate, listen, I mean, in the worst case scenario, and Mark, we had this discussion before the event started. You can say no. Most tech deals are still structured as stock deals. And if an asset deal doesn't work for you, if you're a C corp, it's not manageable. It's perfectly acceptable to tell the buyer, I can't do an asset sale.
Which is always going to be.
Yeah. Yeah, and I.
Go ahead, Kate.
And always at the, this is especially helpful at the term sheet phase.
Yes.
I would say, to mitigate your risk here, always, check with your advisors before you sign the term sheet, because that's when you kind of get locked in. And it's important to identify these issues before you've kind of started down the path of a certain structure for the deal.
Yeah, no doubt.
All right, we're going to move along because I'm taking a little bit of time here. Let's talk very quickly, and I'll distribute these slides. How to mitigate your liability risk in an asset sale. What you got to do is ring fence those areas which are really bring down the company risks. You want to allocate, you want to figure out what it is that potentially is catastrophic. And in most cases, it's IP infringement, the risk of a third party submarine patent or troll out there that could potentially challenge the business. The privacy. If I know there was an EHR company which signed up for the webinar. I mean, God forbid there's a breach and customer medical data is compromised. I mean, that can be a big ticket liability item. Cybersecurity issues. If you're a renewable energy company, you may have environmental issues. So we know what quick recommendations here is. It's if you're doing an asset sale, again, there's going to be the reps and the warranties, but there's also going to be this concept of pre-closing liabilities that buyers call excluded liabilities. Those are solely your responsibilities. You can see how a rep and warranty breach can be easily characterized as an excluded liability. You could say, if for example, an IP infringement claim, you could say, well, the original sin dates back to pre-closing. So it's a excluded liability. It doesn't run against the basket. It doesn't run against the cap. It doesn't run against the, the limitations on liability. So I would say when you're negotiating your APA, your asset purchase agreement, make sure that the liability silos flow through the same channels, subject to all of them, whether they relate to pre or post-closing period. You can consider buying rep and warranty insurance. They're very popular in the bigger deals. I'm not convinced they're all that useful in the smaller middle market deals. I mean, you wind up paying a premium. There's a retention amount, which is essentially an escrow deductible, which is at risk. It's smaller than your contractual escrow, but it's still at risk. And the insurance policy, the insurance company is not going to pay if you fall under one of the exclusions. I mean, essentially, the insurance company is saying they're going to insure you for reps and warranties that you give based on what you tell them. So if your rep and warranty is breached, they're going to say, well, you didn't tell me what you was, you breached the obligation of informing me, and it becomes circular. Lowenstein Sandler, the corporate law firm in New Jersey, just did a study that 87% of all R&W claims have been challenged. Most of them wind up being settled, and buyers still have recovered more than half of what they've sought. But there is, there's a challenge there. And finally, one of the strategies which Lenny champions here at Flatiron is to go ahead and identify those areas of high risk and get tails. For IP, for cybersecurity, you can buy tails that extend out into the post-closing period to protect you and the buyer. So you don't have to cover every rep and warranty, cover those that are big ticket items.
Just on that point, with regard to getting a tail, you have to first have the policies in place. So many of you in the tech sector know about the E&O insurance, cyber risk insurance, privacy insurance, and so on. They're usually called cyber policies. You have to have that policy in place, which they're reasonably priced in most places. However, they should be based upon an audit of your business. I'll talk about this in preparing for a potential sale in the next webinar. But if those policies exist and they're sizable, they can protect you. And also the other point that Connor just made, that 87% of the rep and warranty insurance, traditional rep and warranty insurance, are litigated, and buyers get get their payout, but the sellers are always liable. So the rep and warranty insurance really doesn't help you as a seller. It helps you. It helps the buyer more than it helps the seller. It's just a shift temporarily to the insurance company, but the insurance company is going to come after you as a seller. Whereas the tail, it's not for a buyer's asset. It's your asset, and it protects you to the extent that you have to step up and pay defense costs, or potentially pay liability to settle out those claims that arose, or as a result of what you previously did, or it might be a late claim that came in based upon breaches that occurred prior to sale. So just keep those other two items in mind.
All right, guys, let's move on to earnouts. There's going to be a specifically dedicated webinar later in the series on earnouts, but this is the second favorite tool of buyers to shift risk by tying all or part of the purchase price to future performance, which obviously in this COVID era is dicey because nobody can predict what's coming around the corner. Just first of all, I mean, there's an inherent tension, whether COVID's around or there's no COVID, there's an inherent tension in earnouts between the buyer's desire to integrate the acquired business into his portfolio and to control that business and to control the personnel and the resources and the budget, and sellers then desire or interest to keep that entity separate so it can be judged for purposes of the earnout fairly, so you have an apples to apples comparison. And that's that tension that's difficult to resolve. So as I was telling Mark before we started this, started the seminar, I think of two things because it's a difficult negotiation. If you're a seller, you've only got limited negotiation capital to deploy. So you got to figure out how hard am I going to fight on the earnout? And the two big questions: is the earnout really the main meal or just icing on the cake? Lenny and I just closed a deal recently with Kate's help, where the buyer walked away with roughly $70 million at the closing. There were some holdbacks, so the net amount was around 55, 56, and there's an escrow that will get next year. And there was also a $15 million earnout. Well, in that circumstance, I got the main meals of $60 million I'm getting at closing. So that's what I focus on. If I get the icing on the cake, that's great, but it's not the driver. We did another deal earlier this year, which was a very early stage technology deal where McAfee bought a security product basically, and 60% of the purchase price was tied to the future development and future improvement of that technology. That's a completely different situation because now most of the purchase price is tied to the earnout. The other thing you got to figure out is, where are buyers' interests aligned here? Is buyer a competitor that wants to get market share, or is buyer a guy in an ancillary space, some guy that wants to plug a hole in his product stack? In the second circumstance, I'm much more comfortable with the earnout because I know that buyer wants my product to succeed in his universe because he needs to plug that hole in his product portfolio. That I just talked about the McAfee deal. That's exactly what happened there. They needed a remote browser product. They didn't have one, and the seats at the musical table were quickly filling up. So they needed a remote browser product, and they tied a lot of the purchase price to the success of that product. But you know what? McAfee needs that product to succeed. It needs to be competitive in that area. On the opposite end, Mark, I go back to an oldie and goodie back in the early artificial intelligence time 20 years ago when there were the help desk companies and it was Network Associates and Vantif and Remedy and Magic Solutions. I represented Magic Solutions when I was just a young guy, and it was acquired by McAfee. McAfee had a competing product in the help desk space. We had an earnout, we had different indemnities. 2 days after the acquisition, McAfee shut our product down and tried to migrate all the Magic Solution customers to the network product. And then they had the gall to tell us that the earnout couldn't be earned. Now, fortunately, they had me negotiating for them, and we got around that. But that's the example, the bad example of the guy that's really just looking to acquire market share. You're not going to have a chance to succeed with your product. So let's think a little bit about, Mark. You can do this together with me too. We can think about ways that you can improve your earnout positioning. And I'm not going to take these all in order. The first thing to do, Mark, is to the extent possible, avoid hardcore financial metrics, because hardcore earnings, profits, EBITDA, revenue, net revenue, excess cash flow, because all those financial results are controlled by the buyer, and he can manipulate the results by what he allocates, how much marketing resources he gives you, how much personnel you have, or just by the way he accounts for things. He may account for things differently. To the extent possible, I love being able to, focus on things that are objectively ascertainable. In the Avalara deal, we did number of new licenses. Those can be counted. It doesn't make a difference how much revenue, number of new licenses. Even Giuliani couldn't contest that counting. Deployment of new technologies, that's something that can be ascertained. If you're going to do financial metrics, then make sure you're comparing apples to apples. Reconcile the financial reporting methodologies, back out the expenses that are not going to be that may be shifted to your budget, from overhead or deal expenses that are not really germane to your business, and that's a negotiation. And then, of course, Lenny, you try to bargain for protective rights and, control over the leadership of the business, access to resources, personnel, rights to participate in marketing campaigns. And of course, Mark, buyers are going to yell because he says, my business, I want to control it.
Yeah. So look, in terms of earnouts, sometimes it's a necessary evil, right? Especially in current times with COVID, where the business might have been impacted, and so kind of the fair or the right thing to do is to give the owner, board, the seller the opportunity to kind of get through this period and earn that additional wealth, on the back end. So how you do it, what Conrad's talking about, there's a a zillion ways to kind of carve this up. The best answer from a banking from us, who represents mainly sellers, we basically say no earnout. And it really depends on the type of industry, company, situation that you're dealing with. The firm that we just sold, it was a large SAP practice, and it was bought by a Madison Dearborn-backed company called Navisite out of Boston. It was an IT. There was a healthy reoccurring element of that firm, as it was a strategic initiative for the CEO to build reoccurring revenue, and he did a great job of that. But there was still kind of this billable hour, project-based, non-repeatable part. And so, in those types of businesses, you see it a lot in IT services and even managed services, implementation systems integrators, where there's always a healthy earnout component. When I mean healthy, I mean maybe like a 20 to 30% earnout component. So you need to kind of understand your business, understand, you really need to understand your future and have really good sales forecasting, sales pipeline management, kind of a quality of forecast or a quality of pipeline analysis done, so you can project out into the future. And what Conrad and I were talking about earlier is like how long, because to his point, the buyer wants to integrate and take advantage of the synergies that are built into their banking model. And the seller says, hey, if there's going to be an earnout, I got to run this thing on my own. And by the way, not only do you give me the ability to run this business as I have historically, but you also have to give me the ability to measure the business as I have historically, based upon my accounting standards and methods and controls, and not yours. And that's another big negotiating point that happens. So it's a challenging part. Less is more in terms of our view as we try to protect and advocate for sellers. But you have to figure it out. The simplest way to do this is to just measure on revenue and have a really tight definition of revenue, and say, hey, you guys are going to run this thing. We're going to do this on revenue. You're going to give me the resources to drive sales and to increase sales, and then let's have at it. So,
and Kate, what should we be thinking about from a tax perspective on earnouts?
We just need to make sure that the earnout is purchase price for tax purposes. Where sellers run into problems is where the earnout is tied to the provision of services or certain employees or sellers staying on, remaining employed in the business and engaged in the business. Now, that doesn't always cause a huge issue. That doesn't always result in services income, but sometimes it does. So that's also something at the term sheet phase we need to be really careful about, to make sure that all the proceeds that the seller is getting from the sale are going to be purchase price, largely capital gains to the maximum extent possible.
Okay, so let's cover the last point here, is what I call here working capital grabs. So the way these deals are done, whether it's a stock deal or as an asset deal, you're going to hear that they're debt-free and cash-free, which means you got to pay off all your debt at closing. Buyer doesn't want any debt to be out there. They don't want lenders to be going after them, but you can keep all the cash. They're not taking the cash in the business, subject to leaving them sufficient working capital. Working capital is essentially net current assets. Current assets are basically cash and AR, and current liabilities is usually, and its basic form is current AP, accounts payable. The idea here is you have to leave them sufficient net current assets that they can operate the business in the ordinary course, in accordance with historical practice, without making a big infusion of capital on their own. There's typically a look back period, 6 months, 9 months. You throw out the highs and the lows, you average everything else. The seller makes an estimate at closing, and there's a true up 90 days after closing, and then there's an adjustment from that. What we found during COVID is that the natural cycle of things has been has been distorted by the impact of the COVID economics. For one thing, expenses are down because you're not traveling as much. There's less T&E. You're not taking as much office space, and you're not paying as much for your third-party developers, and sellers are, and the other thing is, founders are being cautious. We've got the founder caution, so they're keeping a lot of retained earnings in the company. Both because they don't know what the future holds, and to have reserves, and they're accelerating the payment of AP. They're accelerating the prepayments. And in some cases, they're actually getting increases in revenue. When they're in those the SaaS categories that are very active right now, like RegTech. I mean, we had a seller recently that that didn't take any cash out of the business. The deal closed in the past 2 months. The seller hadn't taken any cash out of the business in several months, other than taxes. And were prepaying all of their liabilities, immediately, out of an abundance of caution. So when you looked at traditional working capital metrics, it looked like that they had, $3-4 million of excess working capital on the balance sheet, because they didn't have any liabilities, and they were keeping extra cash. They weren't distributing the cash to themselves. So what do you think happens? The brilliant boys and girls at KPMG come back and say, we got to leave $3 million in the business because that's what the average you left at past 6 months. To which I say, I got to leave $3 million in the business against $200,000 of AP. And needless to say, we didn't wind up leaving $3 million, but we wind up leaving a lot more than we should have. And that's why I'm surfacing this issue at the in this presentation, because it can be an expensive item. Mark, I mean, we can talk about Mark.
Sometimes depending on how aggressive the buyer is, it could be, they try to game it for a grab back, and sometimes sellers do the same as well, frankly. So, the idea, as Conrad said, you want to leave enough money in the business to run the business for a certain period of time. And there's some, it's not just as easy as current assets and current liabilities minus current liabilities. There's some negotiating that goes on the sub accounts underneath those categories and other categories. The big definitions, debt-free, cash-free, what's debt? What are we counting as debt becomes a major issue. There's always an issue in a software SaaS company or a managed service company, in terms of deferred revenue and how you allocate for that. And, some people want to give back for all the deferred revenue. Obviously, that's not going to work for sellers. And it's really the support, how much of that, how do you support that deferred revenue going forward? Is the cost of support is really the fair way of looking at it. So look, Conrad and Kate said this a couple times, this type of the working capital definition and the working capital calculation, should be worked out at the term sheet level, at the LOI level. Takes a little bit more time. You need to get your banker and your attorney involved to kind of figure that out. But it really helps minimize these negotiations and potential, grabbacks that buyers will, take advantage of if they can, later on in the deal, or when we're trying to wrap up the paperwork to close the deal. So
yeah, I would say 2 things here on the last page. Control the narrative. So consult with your banker, with your auditors, understand what your normalized working capital looks like against your COVID working capital, and control the narrative at the term sheet stage. Tell the buyer, this is what we have, this is what we've done historically, and propose the formula yourself. Propose what's fair. You're going to leave 125% of net current liabilities, for example. And say, throw out the window the old-fashioned way of doing it, because it doesn't apply. The other thing, Mark, is always make sure that you're comparing apples to apples. As Mark points out, there's lots of tricky issues. You got your accountant on 8th Avenue who's doing your books, and you're gonna and the true up is going to be done by a bunch of young geniuses at KPMG in Seattle. We're going to spend 90 days poring over your books. So you make sure you've accounted for things like customer deposits are tricky because they're cash on the one hand, but they're all liability in the other hand, and they defer the calculations. You treat that as debt, you treat it as working capital. We typically treat it as a third category. Deferred revenue, as Mark points out, prepaid assets. Make sure you have, if sales tax and issues like that are going to be into the calculation. Because as sure as the sun's going to come up tomorrow morning, when you get the true up 90 days after closing, the accountants for the buyer are going to throw in a bunch of liabilities you weren't thinking of as traditional working capital liabilities.
So the goal, and Conrad, and as the goal is to create a bandwidth where no one gets anything after that 60-day.
That's right. It's supposed to be neutral.
Supposed to be neutral. So so in order to do that, you need to have really decent accounting in your business, which unfortunately a lot of firms don't. They need to be near GAAP or as much close to GAAP as possible. They need to be granular and things like that, so that we could do the scenario analysis before you sign a term sheet or LOI, and that things go smoothly through the close. And so it's important to have all that kind of stuff, but because the goal is to negotiate the bandwidths, no checks are written, 100 grand above the target, 100 grand below the target, or something like that, and you walk away, both parties walk away unscathed. So look, in fast-growing software companies, in healthy companies, that are doing well, people will look later on the working capital issue than if, it's somewhat distressed, or if we're going through hard times like today. And we didn't even mention things like PPP and how that could impact, particularly. That's probably a whole nother discussion that we'll have when we focus in on working capital in a later session.
Yeah. Lenny, do we have any questions? I'm not going to cover stock on this presentation. We don't have time, but anything that anybody wants to talk about?
We have no questions that are written, but we have a bunch of people, more than we started with, that are all watching, and their microphones can be turned on. So any of you out there that have some questions, or some of our friends that are watching, Bill or Tim or otherwise, or Mo, please inject. We're welcome for another couple minutes.
Hey, while people are thinking about that, the only thing I'll say about equity is in this current pandemic era is, especially in when private equities are buying platform companies, we see, or even tuck-ins to their platforms, the equity role. I'm a seller, I own 100% to make it simple of my stock. How much am I willing to roll? And that is a kind of a way to balance the risk, maybe even to get a higher, valuation, or at least be able to harvest, if you're bullish on your business and the buyer's business, to harvest some more wealth in future periods, which is probably a good idea, but it's all situational. So the role is another important consideration that we can talk about in some future session.
Yeah, I mean, three things to think about with equity is, how is it going to impact your tax position? How are you going to liquefy, monetize the equity? And how is it going to get valued, particularly if it's contingent equity? I mean, who's taking the risk of the market changing? And then of course, Mark, there's the whole other issue of using equity in private transactions like the private equity funds do, where typically the sellers are going to roll back a portion of the proceeds into the new company or to the acquiring company. And that's a whole different kettle of fish. And that's almost, you become an investor in your own company in that scenario.
Yeah. And you're totally aligned with the future growth plans and, strategic plans of the business, which is another way to kind of get alignment, seek alignment. But, in most cases, and I'd say in a majority of cases, you may not get what you want up front, but you get it in spades post, in the future, if you're with the right backer and et cetera, et cetera. But people do well with their rolled equity, typically.
We got a question here, Lenny?
Nope. Nope. Some people have said thank you very much for the information so far, but if there are no questions, I'm going to let Conrad.
William, Bill Beers, do you have a question? You're on mute.
Thank you. Okay, I really love what you've done because it's clarified the highest points on taxes, on structure, and planning. I think the most important thing is this is a planning operation, and you should not be doing your planning at the time when the term sheet's showing up. You want to have everything clean. You want to do your due diligence beforehand, and so that you're in a position of strength as a seller to say, okay, I'm ready to give you this rep and warranty. I'm ready. I've already covered that through my insurance. I've covered through my tail. I really applaud what you're doing here, because getting out is not just a short-term deal. It's a planned deal, and that's why you need investors like you and attorneys and accountants and everybody else. It's a plan. So this is the most important. It's a great opportunity, because then with the planning, it's easier and better. So great job.
You're preaching to the choir with Mark.
Thank you.
So we do have one question out there: how does the seller protect itself from the next coming disaster? And they seem to be coming in waves with COVID. And how do you protect against those disasters? When you have projected milestones that you're trying to meet, which is what Mark and I were talking about actually before the seminar started. There's a phrase, Conrad, you can talk about material adverse effects or otherwise. How do we address that if people were unaware of the COVID problem, and now they're aware of the COVID problem, but there'll be something else in the future? What do they do?
Well, look, that is, as Mark points out, that is the big risk factor to having an earnout in the era of COVID. Is that it's just not predictable. Now, some of our sellers have had fairly predictable results, so they're comfortable projecting forward. There is no easy answer. That you could try to build in some sort of material adverse clause, but that's a difficult negotiation to have on an earnout. Again, I try to mitigate that in part by shifting to non-financial metrics into more hardcore metrics like technology or product development, team development, the things that are not necessarily tied to the market. But Mark, it's a hard problem in this market to predict.
Yeah, so a couple of things to think about is, again, it's all situational. It really depends, and you really need to dig in. And it goes back to what Bill was saying around planning and getting your act together. But in some situations, the IP that a software company has, it just could be worth so much more, and it took so much time and so much money to develop it that the buyer could never kind of replicate that fast enough to take advantage of the hole in their portfolio or the market that's in front of them that they want to go exploit. So how do you do it? Sometimes what we've negotiated a couple times is an option to extend the earnout another 6 months or a year to kind of over that rough bridge. So there are techniques, and strategies that you could evaluate, but all goes back to planning, all goes back to forecasting. Obviously you can't forecast, when the next crazy event's going to hit us. But
and the other thing, Mark, is don't make it a winner take all outcome. So make it an incremental, so that so to start earning the earnout immediately as you reach milestones. And if somehow there's a break in the action that happens in the future, you've at least earned something. That maybe you have to meet a minimum threshold before you start earning, but you start earning incrementally. so that you know you're hedging your risk a little bit against the future.
Yeah, I mean, there's a lot to think about. It goes back to this: is this the main meal or this is the dessert, or you know, and so you know how much of the dessert do you want to have? So good question, though. Really good question.
Okay, well, thank you for that person who raised that question. I'll let Conrad do his programming wrap up, and then I'll do a final wrap up. So go ahead, Conrad.
So guys, whoever signed up for this, I'll send these slides. It's a little bit of stream of consciousness, but if it's helpful, I'll share it with everybody. You know, if you want to reach out to Kate or to Mark, you know, just let me know. I'll give you their contact information. The next webinar that we're scheduled to hold is on January 20th. That's a Wednesday. They'll also be at 11 a.m. And that webinar is going to focus on planning, and it's going to be focused on planning, and it's going to focus on getting your company ready for sale, both from a corporate and tax planning perspective, and also from a logistical and due diligence perspective. And that webinar will be hosted by Mark and Lenny together. That's all I got, Lenny.
Okay, thank you everyone for attending. We will send you these slides and also the link to the webinar that will be on YouTube. It takes a few days for Zoom to publish that to us, for us to then edit and post. So give us a little time to do that. We won't see you guys until after the holidays, so enjoy your holidays. Thank you very much for attending.
Thanks, everybody. Thank you.
Bye-bye.